2024 was the year when technology stocks, particularly the stocks of the Magnificent Seven that includes Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta Platforms, and Tesla, saw significant gains. Advances in artificial intelligence continue to drive growth across various sectors. Companies like Palantir Technologies see massive stock rallies due to the strong demand for their AI platforms. Economies worldwide started to reduce interest rates, with the Federal Reserve initiating a series of rate cuts throughout the year. Money market fund assets reached record levels, surpassing 7 trillion, driven by investor demand for safe haven assets. And maybe the most significant event of all was the presidential election that saw Donald Trump win a second term, which boosted market optimism due to his policy on deregulation, lower taxes, and energy independence. So with all this going on, and with it being quite a while since I provided the last update on my general investing account that I hold with Trading 212, I thought that now would be a good time to look at how my account has performed in 2024 and to see what the prospects are for the new year. I opened this general investing account a while back as I had maxed out my allowances on my ISA and figured that I could continue to be invested in the stock market and then transfer these assets over to my Trading 212 Stocks and Shares ISA when I get my new ISA allowance this April for the 2025-2026 tax year. I felt that investing through a general investing account would be a good way to also make use of the other personal allowances I currently have in 2024-2025. I have created an investment portfolio pie, and this enables me to choose the exact proportions that the ETFs within it take. And the pie that I've created consists of 4 passive ETFs, where the OCFs are low. Passive means that they just try to replicate an index rather than trying to beat it. This would be known as active investing and comes with higher cost and higher risk, often for no greater reward. As Trading 212 does not charge any platform or custody fees, my total fees for investing in this pie of ETFs just consist of the OCFs or ongoing charge figures. This is the administration figure that the fund charges. The total charges for me holding the 40 ETFs in their proportions is just 0.12%. This is very low and means that I keep more of my money for investing and less for paying fees. My portfolio pie is a 60-40 equity bonds portfolio to provide some diversity between asset classes to smooth out any price volatility. Bonds and equities are generally negatively correlated, meaning that their prices often move in opposite directions or at a different pace in the same direction to hopefully reduce drastic price movement. Although this is not a given, and prices could correlate in certain circumstances, such as if interest rates were to start rising again. And be minded that a 60-40 portfolio with 40% bonds will dampen price movement in both directions, meaning that it could dampen the gains that you would get if you were invested 100% in equities or stocks and shares. So the proportions you decide on should be in line with your capacity and tolerance for risk, in accordance with what your goals are and the returns you desire. My age and the fact I'm getting closer to depending on invested funds is an important factor in deciding to include bonds for stability purposes. As a younger person, you might decide not to include bonds and to maximise growth through stocks and shares. The higher growth you seek will come with the added risks associated with increased price volatility that might be less of a concern to you while you're not seeking to withdraw income in the shorter term. And if you are finding the contents of this video useful, then it would be grateful if you consider hitting that like button, subscribing to my channel, and to turn on notifications so that you'll be aware of when I post new content. There is no overlap in the 4 ETFs that I invest in within this pie. What I mean by this is that I'm not investing in the same thing twice in different ETFs. Sometimes people invest in a global equity fund, but then also invest in a more regional fund. A common example being a fund that follows the S&P 500, which is an index of the largest US companies. They therefore invest in the same companies twice, as though larger US ones also take a big market proportion of the global indices and the funds that follow these. I'm not saying there's anything wrong with this, and investors often do this deliberately, as long as you understand that this is what you are potentially doing when you invest in multiple ETFs. And maybe do so because you seek increased exposure to a particular region, sector, or company. Although there are no platform fees with Trading 212, they do charge you a foreign exchange fee of 0.15%. So all ETFs in my portfolio either have sterling as base currency, are sterling denominated, or sterling hedged, and are all traded on the London Stock Exchange to avoid any forex fees. My portfolio consists of 55% in the Vanguard FTSE Developed World ETF that has a ticker of VHVG, and this has an OCF of 0.12%. This fund is made up of companies from the developed world such as the US, UK, Japan, and the larger EU economies. 40% is from the Vanguard Global Aggregate Bond ETF with a ticker of VAGS, with an OCF of 0.1%. This consists of good quality investment grade government or corporate bonds of varying duration of anything between 1 month and 25 years. Towards the end of 2024, Vanguard published a report advocating that investors consider an increased exposure to bonds within their portfolios going forward, even suggesting a 50-50 equity bonds approach. Vanguard expects lower returns from the US stocks compared to previous years. High valuations and market momentum are likely to drag down long-term returns, and they expect interest rates to remain higher than they were in the 2010s. This environment is seen as beneficial for cash and fixed income returns over the next decade. Vanguard projects annualized returns of 4.3% to 5.3% for both US and global ex-US currency hedged bonds over the next decade, and a better return trade-off in fixed income, making bonds an attractive option for long-term investors. They emphasise the importance of diversification and having a long-term perspective, and suggest that bonds will continue to play a crucial role as a ballast in long-term portfolios. Vanguard believes that an era of positive interest rates, real money, will continue, which is positive news for bondholders. And overall, Vanguard's outlook is optimistic about the prospects of bonds in 2025 and beyond, provided that investors maintain a diversified and long-term approach. Getting back to my portfolio, where 3% is in the Vanguard FTSE Emerging Markets UK ETF with a ticker of VFEG, with an OCF of 0.22%. This consists of countries from the developing world and includes potential powerhouses such as India, China, Taiwan and Brazil. 2% is in the iShares MSCI Target UK Real Estate UKITS ETF with a ticker of UKRE. This is a UK real estate ETF. It includes lots of property companies owning property portfolios such as commercial property, student rentals and storage facilities. When it comes to emerging markets, you can include them in global funds if you like. I've chosen to invest in a separate ETF as it's generally cheaper to do so this way, and you also then get more choice in the proportions that you set. I want lesser exposure of 3% in my portfolio rather than the 8 or 9% that global funds offer. Depending on your investing timeline, you might consider including emerging markets either as part of a global fund or separately and in similar 8 to 9% proportions. The argument being that the growth could come from the likes of China and India in the longer term if you have sufficient time to wait. So let's check on the figures to see how my portfolio has performed over the last year. And the total value of this portfolio is currently £14,698.90. This gives me a total return of just under 20% and a total rate of return for the 20 months I've had this account open for of a much bigger 30.3%. These returns are predominantly driven by the Vanguard Developed World ETF providing me with 23% returns. This ETF has a large exposure to US stocks including those of the Magnificent Seven. The Vanguard Emerging Markets Fund has also provided me with a healthy 12% gain, with India and South Africa performing particularly well. Taking all things into account, including the Vanguard report that I mentioned, I'm content to continue at the moment with a 60-40 equity bond mix, with 40% exposure to bonds being just about right for me at this time. My only real concern in the portfolio at the moment is the poorly performing iShares Real Estate ETF, which is reflective of the current UK property market. As this is only 2% of my portfolio, I'm happy to continue with this at this time, in the knowledge that I'm purchasing shares at a cheaper price, but I will be assessing this again later in the year. Thanks once again for watching.